Hello, Professor. My name is Xian. I will talk about sharing compliant stocks today, focusing on two questions: the role of the Islamic equity market and why companies prefer equity-based financing. This is our members. 苏杰、董任龙、马生超、邵兆全、谢小卓。Next. The Islamic capital market is more than just a financial system. It's values-driven framework rooted in ethics, fairness, and shared responsibility. Today, we will explore how this market not only grows financially but also strengthens faith-based trust. The first one, role of the Islamic equity market first. What is the Islamic equity market? Simply put, is a marketplace where stocks are screened to ensure they comply with sharing principles, no interest, no excessive uncertainty, and no involvement in prohibited industries. Its key roles include providing ethical investment channels for Muslims and conscientious investors, um, mobilizing capital toward socially responsible businesses, enhancing investor confidence through transparency and compliance. But it doesn't stop there. This market actively supports Islamic backing by expanding funding sources beyond traditional deposits, encouraging innovation like Sukuk and Islamic ETFs, raising the bar for regulatory and ethical standards across the industry. And the data and real-world impact. Let's look at Malaysia as an example. The FTSE Bursa Malaysia EMAS sharing desk has consistently performed well, attracting both local and international investors. This shows that ethical investing is not just a nature, it's a growing global trend. Studies also show that sharing compliant firms often exhibit stronger governance and lower debt levels, making them more resilient during economic downturns. And that's why equity financing. Now, why would a company choose equity financing over debt? From an Islamic perspective, equity aligns with the principle of risk sharing, what we call moderable and measurable. Unlike debt, equity doesn't require fixed interest payments, which avoids risk. It also builds a partnership, a net between investors and companies. In contrast, debt financing can create pressure during hard times and may not align with long-term stability. And then, first, equity financing offers several advantages. No fixed interest repayments. Companies can reinvest profits during growth phases. Shared risk investors and companies exist together and attracts ethical company. Many investors specifically look for sharing compliant options, enhances reputation. Being sharing compliant builds trust with customers and communicates. And the cons of equity investment, of course, there are challenges. Ownership dilution, founders may lose some control. Dividend expectations, shareholders often expect regular returns. Market sensitivity, stock prices can be volatile. Higher transparency is required. Companies must disclose more, which can be demanding. But in many cases, the benefits outweigh the costs, especially for firms committed to long-term ethical growth. And then conclusion. To wrap up, the Islamic equity market plays a vital role in promoting ethic finance, supporting Islamic banking and attracting conscious investment. Equity financing, while not without challenges, aligns deeply with Islamic principles of fairness, transparency, and shared responsibility. Moving forward, we believe this market will continue to grow, driven by innovation, trust, and values. That's all on my part. Next.
Assalamualaikum, Doctor. And then in my part, I will continue to discuss issues pertaining to dividend purification in Sharia compliance talks and recommendation to improve Sharia screen. First, accurately identifying the non-halal income is difficult because companies rarely disclose detailed sources of prohibited revenue. Investors often rely on estimates or financial rations. Second, there is no unified standard for purification. Different Sharia both apply different benchmarks and calculation methods, leading to inconsistency. Third, the issue of timing and responsibility remains unclear, including when purification should be done and whether it is the duty of the investor, fund manager, or institution. Fourth, the distribution of purified amounts poses challenges. The non-halal portion must be donated to charity without intention of reward, which requires proper monitoring. Finally, there are ethical concerns as frequent purification may indirectly justify ongoing involvement in non-Sharia compliance activities. Overall, dividend purification is a practical solution, but it involves methodological and ethical challenges. And then let's discuss recommendations to improve Sharia screening. To improve the effectiveness and credibility of existing Sharia screening methodologies, several key recommendations can be made. First, greater standardization across jurisdictions is needed. Currently, different Sharia board and index provider apply varying financial ratios and interpretation. Harmony core screening criteria, while allowing limited local flexibility, would reduce inconsistency and enhance investor confidence. Second, improving transparency and disclosure by companies is essential. Firms should be encouraged or required to provide clear breakdown of non-Sharia compliant income, interest-bearing assets, and debt structures. Better disclosure would allow more accurate screening and dividend purification. Third, screening methodologies should adapt a more dynamic and forward-looking approach. Instead of relying solely on historical financial data, Sharia screening could incorporate chance, risk exposure, and company strategy intention to move toward greater Sharia compliance. Fourth, there should be stronger integration of qualitative screening. Current practice often focuses heavily on quantitative financial ratios, while governance quality, ethical conduct, and business practice receive less attention. Including qualitative Sharia and ESG-related factors would be better reflect the objective of Sharia. Finally, regular review and scholar collaboration are necessary. Screening standards should be periodically resisted to reflect change in financial markets, product, and business models, with closer cooperation among Sharia scholars, regulators, and industry practitioners. Overall, enhancing standardization, transparency, dynamism, qualitative assessment, and scholarly coordination would significantly strengthen existing Sharia screening methodologies.